So we'll now move on to reading 40 of the CFA curriculum that deals with working capital management. A lot of the concepts we've already studied in the review on financial reporting and analysis. However, we'll take a brief look at everything again and understand something new. So we'll start with the various measures of liquidity, understand the short-term investments that a firm can make if it needs to, the concept of receivables and rather the management of receivables, inventory and payables, the concept of the cost of trade credit, very important, please pay a lot of attention here, and wind up by understanding some short-term sources of funds that firms can go to if needed. Liquidity refers to the cash at hand or the cash at disposal that the firm has. The primary sources of liquidity include sale of goods and the money then hence collected, the collection of receivables, so on and so forth. Short-term funding can be taken from the trade, that is from your accounts payable, or you can go to a bank and get a line of credit, as we'll see. So these are the sources of cash or the sources of liquidity that the firm has. The secondary sources include the sale of short-term assets or long-term or long-lived assets, renegotiating the terms of the debt, or filing for bankruptcy and thereby receiving assistance in the reorganization of the company. So please remember that primary sources is what the company should normally mostly rely on. Reliance on secondary sources may sometimes alter the financial structure and the operations if you need to renegotiate debt, sell your long-term assets, or file for bankruptcy. So this may indicate a deteriorating position of the business and should normally not be resorted to. So drags on liquidity refers to items or activities that delay or reduce the cash inflows. So if some receivables remain uncollected, or if I get bad debts, that is people don't pay up, or if my inventory becomes obsolete, that is I will not be able to recover as much as I originally envisaged, then all these items are drags on liquidity, that is they are either reducing or delaying my cash inflows. Similarly, pulls on liquidity are also negative. They have a negative impact because they accelerate cash outflows. They don't delay inflows, but they accelerate cash outflows. For example, if I'm required to pay vendors sooner than optimal, or if my credit terms change and I have to make a quarterly interest payment or a monthly interest payment or principal repayment as against earlier, then all these would be pulls on liquidity. Drags and pulls on liquidity are items that companies should be careful about, and it should have contingencies in place to deal with these issues. So there are many measures to understand the liquidity position of a company. We studied liquidity ratios in financial reporting and analysis. The first ratio, please recall, that we studied was called the current ratio. That was simply the current assets of the company divided by the current liabilities. Please remember, the difference between the current assets and the current liabilities is called as working capital. Current assets include cash, accounts receivable, inventory, marketable securities, so on and so forth. Current liabilities include accounts payables, any current portion of the debt or any short-term debt that is due to be repaid this year. If current assets are too high, then that may mean that cash is lying on my banks and is being suboptimally utilized. If current assets are too low, that means I will not be able to meet my short-term liabilities and I may need excess funding. Similarly, the next ratio we calculated was the quick ratio. That was assuming inventories are not current. That is, the quick ratio only has cash, marketable securities and receivables in the current assets divided by the current liabilities. Please note, the interpretation, understanding of the ratios remains exactly the same as then. That is, ratio must be compared. We must check the industry average. We must see the competitors' ratios before we make any judgment about our company. However, these are some measures of liquidity that the firm should keep track of to understand its short-term funding position. We also studies the receivables turnover, that is the sales upon the average receivables. We now want to check it as credit sales upon the average receivables. That is, how many sales did we make in which customers had the option to pay later, divided by the average receivables from such customers. So if $100 were such sales and $50 were the receivables, then the turnover ratio is higher. The turnover ratios means longer the customers are taking to pay my amount or to pay me the money due. This can also be judged from the number of days of receivables that is calculated, please recall, as 365 upon the receivables turnover. So again, the same interpretation. Too high a number of days of receivables means there's a possibility of bad debts. If this number is too low, it may imply a bad business practice, or I may lose customers because my credit terms are too stringent. So we must compare the ratio with other ratios and with other companies before we make any judgment. We would also like to measure the inventory turnover ratio, as liquidity can get stuck up in inventory if I have too much of it. So the cost of goods sold upon average inventory was the inventory turnover ratio, and the days of inventory likewise can be calculated as 365 upon the inventory turnover. Too high a ratio indicates I'm keeping too much inventory. If the number of days of inventory is too high, that means I'm possibly keeping too much inventory. I run a high risk of obsolescence. If the products become obsolete, I will entail a high storage cost, etc. If the number of days are too low, that means there is a high risk of stock out. That is, if there is an unexpected surge in demand, I may not be able to meet the additional demand and I may lose market share to my competitors. So again, the analysis and the method of assessment remains the same as the other ratios and as we studied in financial reporting and analysis. We also studied the payables turnover ratios and the number of days of payables that determine how long am I taking on an average to pay my suppliers. Too soon is also not optimal, and too late can affect the relationship between me and my suppliers. Now, a very important metric to judge the effectiveness of my working capital, or to understand what kind of investments do I have to make in the short term in the working capital, that is in the current assets, is first the operating cycle. So operating cycle is defined as the time taken to convert raw materials into cash. The operating cycle is calculated as the days of inventory plus the days of receivables. So this is the amount of time that the raw material sits in inventory, and after being sold, this is the amount of time taken for me to collect the cash. So the sum of these two will tell me the total time taken to convert the raw materials to cash. Higher the operating cycle, higher the investment the firm needs to make in working capital, or higher the amount that the firm's capital will be stuck in inventory and receivables. The second calculation is called the cash conversion cycle, that is defined as the time taken to purchase the raw materials, create the product, sell it, and collect the cash. It will be calculated as the average days of receivables plus the average days of inventory, that is the operating cycle, minus the average days of payables. So if I'm paying my suppliers late, or if I pay them only after I receive the money, then the receivables don't matter so much, or their effect will be more benign, as I may be getting the money late, but I'm paying my suppliers also a little late, or the investment in working capital will not go up as much. So the cash conversion cycle is the time taken to purchase raw materials, create the product, sell it, and collect the cash, calculated as days of receivables plus days of inventory minus days of payables, the same formula that we studied in financial analysis techniques. The interpretation remains the same. Too high a cash conversion cycle means higher investment in working capital. Firms also like to keep track of their daily cash position, also known as the cash on hand. So this refers to the uninvested cash balances in the banks of the firm or with the firm in any form. Once again, cash inflows happen from sales, collections of receivables, dividends paid by subsidiaries, interest income, borrowings from debt, etc. These are sources of inflows. Outflows happen as payments to employees, vendors, interest expense, principal repaid on the debt, taxes, so on and so forth. Now, a company at all points in time must assess the inflows and outflows so as to ensure that it has a daily cash position that is sufficient to meet these expenses as they become due, but the company should still avoid keeping too much cash uninvested because it is being suboptimally utilized. So firms should analyze the expected cash inflows and outflows over the short term, over the medium term, and over the long term to try and get a better sense of periods that may require short term funding. So if we see a lot of bonus payouts happen towards the end of the year, then we may need some extra cash to be paid out during that time. If we see that there is seasonality in our business and the peak season of sales is during the June quarter, then we know that in the June quarter we will have a lot of excess cash and we may need to invest it. So this will help us identify periods where we will have excess funds that need to be invested for the short term and periods that we need short term funding. So this is what the firm should keep in mind while assessing the daily cash position, how the firm can raise the funds and how it can invest excess short-term funds we'll study in the coming slides. So if the firm has excess funds in a particular period, in a particular quarter, let's say, that has to be invested for a period of 6 months before which the big outflows on bonuses or employee expenses are expected to come, then for a short 6-month period, I need this money to be parked somewhere. I cannot invest it for the long term because the outflow is going to happen in a shorter period of time, but for that short period, I need to invest it wisely. So these investments can be made in various securities. These are normally fixed income securities, and the details of each we will study in the review on fixed income. But please recall that US Treasury bills were short-term securities. All bills were short-term securities maturing in less than 1 year. That is one avenue where we can park the funds. Similarly, other government agencies also issue short-term securities like Treasury bills. We can do fixed deposits with the bank, also known as a bank certificate of deposit. We can invest in bankers' acceptances. We'll study this in the coming slide. Time deposits are similar to certificates of deposits. Repurchase agreements. We can invest in commercial paper issued by other companies. Invest our funds in money market mutual funds. So these funds also invest in securities that we have discussed above, that is short-term securities. Or we can purchase adjustable rate preferred stock. Adjustable rate preferred stock is a floating rate security where the interest rate on the preferred stock changes with the change in a reference rate. That reference rate can be LIBOR that we will study in fixed income. So as the floating rate changes, the coupon payment on these instruments also changes or adjusts with the changes of the reference rate. So some avenues where we can park our funds for the short term if we have excess cash, as studied earlier. How short-term investments are quoted, we studied in the review of time value of money in the quantitative section. That is, there are various discounts that are quoted. The economic meaning of all discounts is the same. However, the convention may vary from market to market and country to country. Some conventions that we studied and we will repeat now were the percentage discount, simply the face value minus the price upon the face value. So if the face value of the treasury bill or any bill is 100 and the price is $90, please note that the price is always at a discount for these short-term instruments since they pay no coupon or they are zero coupon securities. So they pay just the face value at maturity. So the face value is 100 and the price is 90. Then the discount is quoted as a percentage of face value, that is equal to 10%. The discount basis yield, also known as the bank discount yield that we studied in the review on quantitative analysis, is calculated as the same percentage discount, that is the face value minus the price upon the face value, only now we annualize it, that is 360 upon the number of days. Please note, in the bank discount yield or the discount basis yield, the year is taken to be a 360-day year. The money market yield is calculated as the annualized holding period yield, that is the face value minus the price upon the price into 360 upon the number of days. So face value minus price upon price is the holding period return that the instrument has given me. So if I purchase the instrument for 90 and it gives me 100 at the end of the year, then the return I've made is 100 minus 90, that is the ending value minus beginning value upon the beginning value. And if I annualize it, that is the annualized return or the money market yield that we have got from the instrument. The bond equivalent yield, please remember, in quantitative analysis, we calculate it as the semi-annually compounded rate of return. However, in corporate finance, the bond equivalent yield is calculated slightly differently. It is actually the annualized holding period yield again. That is the same as the money market yield. However, instead of a 360-day year, we now take a 365-day year. So it is the same as face value minus price upon price into 365 upon the number of days. If the question mentions this formula, then you must use this formula. If nothing is mentioned, then you can use the bond equivalent yield as the semi-annually compounded annualized rate, as we studied in the section on quant. So please refer back to the session on quant if you've forgotten any of these yields. We explain all different conventions with detailed examples there. Now, it is generally advised that firms adopt a cash investment policy. That is, if there is excess funds, how should they be invested, in what type of securities, who should invest them, and how should that management be done, should be documented in an investment policy. The objective of cash investment is to earn a market return, or is to earn a suitable return without taking too much risk, as in the short term, cash outflows are also expected to happen. So these are short term investments. We don't want to take too much risk on them. Normally, these are invested in short term securities, as we discussed, of high credit quality, that is treasury bills or other government securities or AAA rated bonds. The reason why we should have a written investment policy and what it should do is just to streamline the process and to make sure that we don't deviate from these objectives. So the policy should state the purpose and objective of the portfolio, that is to earn a short-term return without taking too much risk. Put limitations on the credit quality, the time period, and the permitted investments. And there should be additional information on who is responsible for investing these funds and what steps should be taken if these guidelines are not followed. So companies can manage their working capital, their operating cycle, their cash conversion cycle by managing the receivables, inventories, and payables well. So we'll first understand the concept of receivables management. An important exercise in that regard would be to understand and document the receivables aging. That is, if I have, let's assume, $700,000 as receivables, then how are those receivables categorized in terms of their age? So we see a big chunk of our total receivables in the month of March were less than 31 days old. Not a very big problem, as the customers will pay when the regular payment cycle comes. About 100,000 are 2 months old. That is, people haven't paid us for over a month. About $50,000 are more than a quarter old. That is, more than 90 days since the sale has been made. We can similarly track these figures for the months of April and for the month of May, and it will help us get a sense of how many receivables are in problem or how many receivables have been delayed too much and special efforts should be put in to recover these receivables. So that's the first step, categorizing the receivables aging. We can also see the aging as a percentage of the total receivables outstanding. So for March, 45% or most of the receivables were less than 31 days. 18% were within 31 to 60 days. Only 9% were greater than 90 days. And similarly for the months of April, for the month of May, that is as a proportion of the total receivables, what receivables are outstanding for what number of days. Another important calculation is to calculate the weighted average collection period, or the weighted average time that our receivables have been outstanding. So we saw that for the month of March, approximately 45% of the receivables were less than 31 days old, 18% were 31 to 60 days old, and 28% were 60 to 90 days old, 9% were greater than 90 days. In general, receivables that are less than 31 days old pay up from about 21 days after the due date. Receivables that are 2 months old pay up in about 46 days. Receivables that are 61 to 90 days pay up in 77 days. And receivables that are greater than 90 days old take a longer time and on an average pay up within 130 days. So if we make a sale today, on an average, the sale gets collected over a period of 51.1 days from the date of delivery. Or this is the weighted average collection period of the company. We would also like to see how this weighted average collection period has been moving across time and how it compares with respect to its competitors and the rest of the industry. Too high a weighted average collection period may again indicate risk of bad debts. Too small may indicate that I'm being too stringent with my customers. And just like we manage receivables, inventory management is also an important aspect of working capital management. Low inventory levels, as we studied, may lead to stockouts. Too large a level will entail carrying cost, interest expense, storage costs. Large inventories can also result in a loss from obsolete items, or the risk of obsolescence will be higher. Managing your inventory well, not keeping too high and not keeping too low, is always going to be a very important aspect of overall financial management. How exactly we do it and how we understand inventories, we've already studied in the review on inventories and financial reporting and analysis. So guys, another important component of working capital management will be accounts payable management. If the company is paying its vendors much prior to the due date, then again cash is unnecessarily used up. And if the firm is paying too late, then it can damage the relationships with the suppliers. So again, that fine balance has to be struck that optimizes the overall utilization for the firm. Typical terms on payables contain a discount available to those who pay quickly as well as on due date. That is, our suppliers will normally offer us favorable terms if we pay upfront or if we pay soon. So an example of the general terms of trade is something like 2/10 net 40, implying that if the invoice is paid within 10 days, then the company will get a 2% discount. However, if it is not paid within 10 days, then the amount is anyways due within 40 days. So you have the liberty to pay me within 40 days. However, if you pay within 10 days, then you will get a 2% discount on the total bill amount. So with this, we move on to arguably the most important concept of this session. That is the concept of the cost of trade credit. That is, what is the cost that I have to suffer if I don't have enough cash to avail that discount that the supplier is offering. And now please pay sincere attention, since none of the books prove this formula the way we are doing it. So if the terms of trade were 2/10 net 60, then again, just for revision, we will call percentage discount in this example as 2%. That is the discount that the supplier is offering. And we'll define days past discount as 50. That is, either we pay up within 10 days or we anyways have to pay within 60 days. So days past discount are 50. Now let's assume that the company has a bill amount equal to X units or X dollars. First of all, when should the company pay this amount of X? It should either pay it on the 10th day and get a 2% discount. Even if it is getting the discount, no point paying the first day itself. Either pay it on the last day and get the 2% discount, so you've delayed the payment as much and you have maximized the discount as well. Or if you're unable to make the payment within the 10 days or the stipulated time to get the discount, then you'll rather pay on the 60th day, that is, delay the payment as much as possible and save on the time value of money. So the invoice will either be paid on the 10th day or on the 60th day. There is no sense in paying at any other time. Now let's assume that the company wants to encash this discount on the 10th day. However, the company has no money. So what is the option, or what can the company do? Even if we have no money right now, we can resort to some sources of short-term funding or borrow the amount from a bank or from the market. So let's assume that the company does that and we get a rate of interest of R. So the bill amount that we will actually pay will be at the end of the 10th day and an amount equal to X into 1 minus the percentage discount. In our example, 2%. If we didn't avail of this discount, we would have had to anyway pay the bill at T equal to 60, but there would then be no discount. I would have had to make an outflow of X. So at T equal to 60, the payment would anyways have had to be made. What I have done by borrowing on the 10th day is essentially availed the discount, and instead of paying the supplier on the 60th day, now on the 60th day, I will return the money to the bank because I borrowed the money and already paid the supplier to avail of this discount. So on the 16th day, now I will directly repay the bank. The bank will take back its principal as well as the interest. The interest rate that was being charged was R%, let's assume annually compounded. So along with the principal that I borrowed, I will also have to pay an interest of R. However, this borrowing is going to be for how many days? I borrowed on the 10th day, an amount equal to X into 1 minus the percentage discount, and I paid on the 60th day, when anyways I would have had to pay the amount due. So this borrowing is going to be for a period of 50 days or a period equal to the days past discount. So the total amount to be repaid will be the amount borrowed into 1 plus R to the power days past discount upon 365. Recall FV is equal to PV into 1 plus R to the power T, where R is the annually compounded rate and T is the time period in years. 50 days would be how many years? 50 upon 365 years. So what we see is that if the company borrows and avails of the discount, then the total cash outflow at T equal to 60 is going to be so much. Whereas if the company does not avail of the discount, then at T equal to 60, the cash outflow will be so much. The company will borrow and avail of this loan if and only if the cost with the loan is less than or equal to the cost otherwise. So we know the percentage discount, X will get cancelled. We know the days past discount. Can we compute R from this equation? Or 1 plus R to the power days past discount upon 365 will be written as 1 upon 1 minus the percentage discount. Or R can be calculated as 1 upon 1 minus the percentage discount raised to the power 365 upon days past discount minus 1. This R is called the cost of trade credit. That is, if you don't have enough money to capitalize on the discount offered by the supplier, then you are effectively still willing to borrow at this rate, or this is the effective rate of interest that you are giving up on for not being able to avail that discount. If the rate of interest R is greater than this amount, then you will not go for the discount. You will rather wait and pay the invoice at the end. If the rate offered by the bank, or if this R is less than this calculation, then it makes sense for you to borrow and avail the discount. So just to summarize, the shopkeeper has two options. Either pay the entire invoice after 60 days, since he doesn't have the money right now, or he can go to a bank, borrow and avail of the discount. If he avails of the discount, then after 60 days he has to pay back to the bank an amount as depicted. If he's choosing that, then this interest that he's paying to the bank is an additional cost that he has to incur because he didn't have the cash upfront to capture this discount. This is known as the cost of trade credit. The curriculum mentions a slightly different formula. Please note, it's the same as what we discussed. That is, the cost of trade credit is equal to 1 upon 1 minus the percentage discount is what we had written to the power 365 upon the days past discount. You can verify that expression within the brackets will simplify down to 1 upon 1 minus the percentage discount to the power 365 upon the days past discount minus 1. So let's do an example and understand the concept. Calculate and interpret the annualized cost of trade credit for invoice terms of 3 by 10 net 60 when the invoice is paid on the 40th, 50th or 60th day. So I'll do it for the 50th day. You can likewise do it for the 40th or the 60th day. So if you assume that payment is happening on the 50th day, then what will be the days past discount? 50 minus 10, that is 40. And what will be the percentage discount? That was given to be 3% on amount 0.03. So we just need to substitute the two terms in the equation and get to our cost of trade credit. That will be 1 plus 0.03 upon 1 minus 0.03 raised to the power 365 divided by 40 minus 1. This will be 1 upon 0.97 to the power 365 by 40 minus 1. This can be calculated as 1 upon 0.97, store it in the memory register 1, to the power 365 divided by 40, and store it in the memory register 2, recall 1, y to the power x, recall 2, is equal to minus 1, will come out to be 0.32041 or 32%. So if you don't avail of the discount, you are effectively giving up on an annualized basis a rate of 32%. Similarly, you can calculate for 2 by 10 net 40 or 2 by 10 net 60 and verify your answers. You should also look at the number of days of payables, that is 365 upon the payables turnover. Analysis remains the same as for the other variables that we calculated. Finally, let's look at some short-term sources of funds that the firm can resort to. So lines of credit are generally given by banks. So in an uncommitted line of credit, the bank has analyzed your books and done some preliminary analysis and has given you a line of credit. That is, in case you need funds in the short term, you can come and borrow from the bank. However, the line remains uncommitted. So the bank hasn't committed any time period or hasn't committed any amount that it will honor. A committed line of credit is a more reliable source of funding. So it is similar to the earlier line of credit. The bank has done its analysis and committed for a period of 5 months, 6 months, or a similar amount, that if the company needs any funds, it can approach the bank and the bank will disburse the amount for a short-term loan. A revolving line of credit is even more reliable. So it is a commitment given by the bank for even long-term funding. That is, even if you want funds 1 year down the line or for a period of 1 year or 2 years, then the bank will honor the commitment and give you the funds as you need. So the better your credit quality, the more comfortable the bank would be in offering you any of these lines of credit. You can also raise funds from other sources, that is pledging your receivables, pledging your assets as a collateral, or pledging your company or pledging the shares and taking loans or borrowing against those. A banker's acceptance is used by exporters, and the banker's acceptance is a guarantee by the importing company's bank that the payment will be disbursed once the goods have been received. So as an exporter, you can use this banker's acceptance and have it discounted at your bank today, or you can raise funds against this banker's acceptance. So the banker's acceptance is a guarantee given by the importing company's bank, that is your customer's bank. And the customer's bank says that yes, you've shipped the goods. As soon as the goods are received, we will disburse the payment. So it is like an accounts receivable or a guarantee of payment yet to come as you have shipped the goods. So the firm can take that document and discount it or take a loan against that banker's acceptance. We saw in the short-term investments part that companies can even invest in other companies' bankers' acceptance. So if other company is expected to receive $100 in the coming 2 months, then I may invest in that banker's acceptance by buying it for, let's say, $80 or $90, so that I give the cash upfront and I receive the amount when the importing company pays. We studied factoring earlier in the review on financial reporting. That is, company can sell or securitize its accounts receivables. So if the company has $100 of receivables dues, it can find an independent investor and sell those receivables for a discounted price. So the company can receive $90 today, and the factor or the buyer is now responsible or takes the credit risk on these receivables, and these receivables will directly be paid to the factor. Another way of raising funds in the short term against your receivables. Finally, if your credit rating is not very good, you can go to non-banking financial corporations. So these are also institutions that will normally lend to you but at a slightly higher rate than the banking sector would. You can also go and raise money on your own by issuing a commercial paper. So what does a bank do? It takes money from depositors, gives them a lower rate, and lends it to corporate at a higher rate, and the difference is the spread that the bank makes. So the corporates can themselves go to the depositors also and raise the money directly, disintermediating the bank. That route or that issuance is called a commercial paper issuance. So when you're investing in a commercial paper, you're giving a loan directly to a company, and the company will pay the investor or the depositor directly without any bank coming in the middle. So issuing commercial papers is another source of raising short-term funds for use in the business. So we've studied some sources of capital, some short-term investments that we can make from the capital, and how the firm should analyze and manage its working capital. So this part did have some overlap with financial reporting and analysis, and make sure that you revise concepts from both parts and you're confident about each of the calculations. Please definitely practice many questions on the cost of trade credit part. Thanks a lot, and see you next time.